Hello, mate.
How are you?
Good. You?
Yeah, very, very well.
Last we spoke, markets had been I suppose in January, had been all messy and the like. It seems that in the bond market,
yes,
everything is rallying really hard. I mean, and we'll talk about that at length. Everyone is trying to find assets now. And it's really interesting one. We can talk about it soon because it seems to me there's not enough assets around at the moment to meet some of the demand. But how's the equity market been?
So what's interesting is there's been a change or shift in sentiment towards China over the last few months, last 8 weeks. We think it's only a sentiment-driven change, and it ultimately will reverse. But nevertheless, there's some optimism that China's going to do something in terms of quantitative easing that's going to stimulate the economy again. And we've also seen some numbers out of China, for example, in the steel industry, showing that steel production's been kicked off again, and therefore, there's going to be more demand for iron ore. So we've seen the iron ore price go up. We've seen the price of Fortescue Metals and BHP and those sort of stocks rise. What we haven't seen is we haven't really seen any rise in the prices of high quality businesses, the sort of businesses that we're interested in. So as a result, we've underperformed over the last few weeks. We don't concern ourselves with that, but that's because the prices of the sort of stuff that we don't like has gone up, and the prices of the things that we do like haven't.
Of the implications. So he's not worried right now about
medium-term implications.
Yeah, the medium-term implications around can we fund this? Will it be sustainable? He is saying, that's the intel that Nick has.
But there's so much excess capacity over there. There's for Aussie equity markets to be rising because of this suggests that there's a second or third order effect that's going to benefit countries outside of China, and I'd argue that that's probably not the case.
Well, and give me your thoughts on this idea about oil. I mean, we can jump into oil because I am really perplexed by the idea that oil being up is good for equities or good for anyone, and when oil is down, that's bad for equities and bad for everyone.
So the oil price collapse is effectively a tax cut for millions of consumers in the United States. Have they increased consumption as a result? Has retail or consumer confidence increased as a result? No. So what would happen if Hillary Clinton gets in and her promise to raise minimum wages to $12 from $7.50 gets through, which is, by the way, a 70% increase in minimum wages in the United States?
She's in an election cycle. It's unlikely to get through. So if my son's watching, I am left. It's all right. I don't think Hillary is it because he's a Sanders guy.
Right.
And he's saying Sanders is the key. So all the youth are on Sanders.
Well, that's good to hear. OK, fine. But what's happening, irrespective of whether Hillary gets in or not, we're already seeing across a wide variety of states, we're seeing minimum wages creep up. So you've got wage inflation starting to happen. If the oil price did go up, and I'm not suggesting that it will, although it's possible, it certainly would be the most painful trade, or one of the most painful trades globally, because no one's expecting it. And if the oil price did surge, then that would suggest to me that we would be precisely, and this is to your point, precisely in the reverse of the situation everyone's anticipating, particularly in the bond market. You'd have inflation and low growth, you'd have stagflation type. That would cause a collapse in the bond market if it were to happen, a collapse in equity markets as well. And markets historically, and we all have enough experience to know this, markets typically do the thing that causes the most pain to the most people. And it's done that in the past many times. So if I was going to say what's the great pain trade for 2016 if it were to occur, it'd probably be inflation, oil price goes up, equity markets collapse, bond market collapses. I'm not saying that's going to happen, but that would cause a great deal of consternation. And items that are purchased frequently. In the past, reductions in inflation have largely been electronics driven. So, but you're not buying a plasma TV it's not plasma anymore, but whatever the technology is, you're not buying one of those every week or every day. You're buying one of those every few years. So this is more interesting because it's more broad based.
Is it a worry? I couldn't hear what that was.
Deflation is always a worry, right? Because for the obvious reasons.
Is that one a worry?
One print, I don't think something we should be concerned about.
I suppose I'll rephrase my question. Did that one print give you cause for worry, or did you
I
just
tell you why,
it's just a one print and it's fine because you
no,
have
what
said
I'm,
higher wages than like...
So what I'm concerned about, as you know, macroeconomics has nothing to do with the way we manage our equity portfolio, but we're interested in microeconomics because that drives the return on equity of the businesses that we own. Mm-hmm. So to the extent that it affects individual businesses, it's interesting to us. We're not as bullish as others about consumer stocks, for example. We think the warm, relatively mild temperatures that we're seeing around Australia at the moment means no one's going to be selling winter jackets or as many winter coats and scarves and hats and beanies and all those things that they normally sell. So fashion for us is something we've got no interest in this season.
With those glasses, of course you have.
Yeah, no. I mean investing.
Right.
How my family dress me is, I don't want you to criticise their
We want to talk a little bit more
sense.
about... We need to talk a bit more about the retail after our break. We've been told
okay.
we have to go for a break.
All right, let's do
We'll
it.
go to our first break. CPI. We were talking about the CPI and we were talking about are you worried?
Yeah, so I'm worried to the extent that combined with an inevitable slowdown in residential property construction, which is a very large employer in our country. Construction industry is a big part of the country. If that will slow down, there's no doubt about that. And we can talk about property market a little bit later and my thesis on that. That combined with lower inflation prints, that would in combination suggest that Australia is slowing down rather rapidly, or it will. And that's to the extent that those two things come together, I am concerned for our country's growth prospects. Yeah. That's why we're interested in businesses that are expanding overseas and investing and acquiring other businesses and generating good returns on those.
I do want to remind me about that overseas acquisition because I want to stay on this idea about the CPI and what it does to interest rates, because the viewers here are either own billions of TDs or have mortgages, and I guess most of the people watching here will have mainly TDs, conservative assets, and I'm concerned that they're...
Although, over the last 5 years, they've migrated out of TDs and into further up the risk spectrum, right, which is where all the volatility comes from.
No.
They have not.
No.
Right, so they haven't chased Telstra shares for their yield. They haven't chased NAB shares for their yield.
I can bring the chart in. I do it every week. I look at the TD chart. Term deposits now are 775 billion. I go to meetings with clients, and I put this.
And what were they
like
3 years ago?
Like the chart is like this.
Is it really?
Oh yeah.
That's interesting.
So
they're going into both because they're not. They are doing what I'm saying.
They're getting paid the money.
Yeah, they're getting paid. They're keeping it in there.
Yeah, and I put the chart up. And I say, with you.
It's fixed income.
I put the chart up and I say, why are you doing this? Why are you doing this? And I say, that's the first chart I start the presentation with. This does not make sense. And it's all about why are you going into TDs as rates go lower and have done so for the last 8 years. And they all look at me like you're a madman. I'm saying, I just don't understand why you're looking at other more conservative assets, or not as conservative, but conservative assets. So the reality is that we haven't done our job of educating. We should get you on every week. But do rates go lower next month?
Stick a wetted finger in the air and guess. I would say that the bias is to the downside, but whether they do or don't, it doesn't matter to me, and I don't know. I'll just expand on what Nick said. That inverse relationship between asset prices and interest rates exists on everything. Property, businesses, farms, every asset has that inverse relationship. And so interest rates act like gravity. As interest rates go up, the gravitational force goes up, the asset value comes down because the present value of the future income, the present value of the future incomes is lower. So because you're using a higher discount rate. And the reverse is true when interest rates go down. So it's true on every asset. So if interest rates were to go up, if the bond market were to collapse because everyone was surprised by inflation re-emerging in the United States, then you would probably find asset prices around the world coming off. I do agree with the caller, though, that the prices of things like Auckland International Airport and Transurban and Sydney airports is insane, and I don't think I think it's justified based on where interest rates are, but I can't see how I'm going to extract anything more than inflation plus a couple of % if I was to buy them at these prices. So this is the new normal, the low return environment that we're in. If you pay prices for assets today, you're going to get a low return.
So Russell,
Love it. In 2013, we criticised Joe Hockey, and I wrote a piece. I wrote a piece in the Australian, and I wrote a piece on our blog, and we updated that today, criticising Joe Hockey for his sort of anti-borrowing stance, that we can't afford to borrow any more money and it's too risky. And I thought to myself, precisely now when interest rates are low, we need to restructure. We need to have a 30-year bond. Why not? Why not borrow money at 3% or 4% for 30 years? You've got an entire generation of people absolutely clamouring for a better interest rate than what you can get on a TD, and they want to invest in something that's safe. So provided the government invests in assets that actually produce a return, provided they don't sell the asset but sell the income stream, a la Mike Baird's approach, so that we continue to own it and we can resell that income stream again, then everyone wins. And I think it's a fantastic strategy. I also believe that it's a better solution than helicopter money. Helicopter money is idiocy. That's a panic station solution. This is what we did during the GFC. We had the schools building
so it needs a bit of bipartisan
program.
Politics. You don't dip into the building program.
We avoided a recession, but we avoided a recession.
I was fine with that.
As a result, I was on a school committee that actually used some of that money to build a hall.
They were talking about that people paid over by 17% or whatever it was to the building, and they did all the analysis. Has anyone ever built a house? If you got over 17%, you've actually done well. You've had a win because they come back and you say, "Oh, the bricks are just that little bit more expensive," and your wife says, "Gee, that looks good. That's
a nice tap."
Yeah, that's all right.
I didn't know you can get that in black.
Yeah, exactly. And then you can laminate it. And it's all
it's black ceramics, only 4 times more.
Exactly.
Oh, right. Okay.
So I think that was quite a reasonable strategy. Now, Michael, the one thing that the gentlemen haven't mentioned, and I think was actually made a lot more sense to my way of thinking, was that the government has come to the realisation that when they look at the growth numbers that we're seeing, the strain on the existing infrastructure and the cost of adapting that infrastructure, it's easier to point people in a different direction. So in other words, if you're all coming into your city, why don't we try and find a way to move you to a regional city? Not physically, but you go out to...
So just on that, I met with Paul Fletcher...
From Penrith, doing those trips.
I've talked about that.
That road is in existence, so it's easier to use that road. What that does is they say to the property people, where are you trying to put homes? What are you trying to do? That plays into maybe a little bit of the Labor Party about the new home stuff, but whatever. It's about where the homes go around those business centres, and I think that's a great idea.
Well, you know what? You could actually kill a few birds with one stone, because what you could actually do is you could create some free trade zones in regional areas where you could encourage startups with a tax holiday, for example, to move into those regional areas. You take the pressure off the infrastructure. You actually grow new cities and universities and students, and everyone moves into that area, and away it goes.
I mean, I don't know.
And our current account deficit probably improves because the market finds out what we're really good at exporting, and we add value to our exports.
So you wanted to make a comment on the dividend?
Yeah, just on the dividend strategy, because you asked me how effective it was going to be. Let me just give you some hard stats. Let's say it's 2005. You got a choice of buying shares in Telstra on a yield of 5.97%.
Yep.
Trujillo is paying out 100% of the earnings as a dividend. No, he's paying all of the earnings out as a dividend, so there's no growth.
Disgraceful.
$100,000 in Telstra earns $5,900 in interest back in 2005. Fast forward to 2016, that's grown to about $113,000, and your dividend of $5,900 has grown to $6,500. Hasn't kept up with inflation. You're behind the 8 ball in terms of purchasing power. Contrast that with CSL or M2 Telecommunications, $100,000 in these companies generating similar returns on equity to Telstra, but retaining profits and compounding it at that high rate of return. $100,000 in M2's grown to $3 million, and we had a 3.9% yield, less attractive than Telstra, but that's grown to 99.8% per annum by 2015. And CSL, similarly, tenfold increase in your capital, and you've now got a yield on your original purchase price of about 20%.
Yeah, right.
So you're better off going for businesses that can grow their income rather than businesses that have a high dividend yield. So you want businesses that grow. So that's the only comment there.
So tell the viewers.
I just did. Oh, what do we like at the moment? A couple of examples. REA Group looks cheap. Now, you might think, how does that fit with my view on property? property.
I don't like this, Roger. I don't
My
like
view
this.
on property, of course, is that we're going to see a correction of some description in property. I don't know when, and don't ask me by how much, but it's already started. Property developers that are coming out of the ground today are going to be selling into an oversupplied market. Banks are lending less on new properties. They're lowering the LVRs, and they're revaluing these apartments now lower. So people are going to be up for bigger deposits and bigger payments when it comes time. They won't settle. So you're going to see not only the oversupply that we've got now, but it's going to be accentuated by an inability of these developers to sell their unsold stock. They're going to have to discount it. Prices come down. So that's going to happen. We're already seeing in the Genworth numbers, they put out their March quarter statistics, and their gross premiums written. Remember, they're writing mortgage insurance. I can't give you that stat unless I look at the numbers, but on this page, but they're accelerating, and that's the point. They're accelerating. The rate of increase is slowing, and they're starting to decline.
In a second, but REA spent $25 million buying something in Brazil, and the stock price went up 3%.
Yeah, that was silly.
I don't like this. I don't like with the herd. They drive me nuts.
But can I just tell you, REA makes their money from the number of listings and the period of time that those houses are listed for. Right. In a maturing market or a declining market, more people selling, that's more listings. They take longer to sell. They're listed for longer. They make more revenue.